The global financial system may be undergoing a significant shift, centered not on equity markets, commodities, or digital assets, but on a long overlooked segment of sovereign debt. Japan, a country known for decades of ultra-low and even negative interest rates, is now seeing a return to positive yields across its government bond market. According to the developments outlined in the article, this change represents a departure from a long-standing financial structure that had quietly supported global liquidity for years. While the yield levels themselves may appear modest when viewed from outside Japan, their significance lies in the historical and systemic role Japan has played in international finance. For an extended period, Japan functioned as a primary source of low-cost capital. Investors and institutions around the world relied on the ability to borrow Japanese yen at extremely low interest rates and deploy those funds into higher-yielding assets elsewhere. This mechanism, commonly referred to as the carry trade, supported a wide range of global asset classes, including equities, real estate, and alternative investments. The article states that this flow of capital acted as an underlying engine for financial markets, helping to sustain valuations and liquidity across multiple sectors. The current shift is reflected in Japan's government bond yields. The 10-year Japanese government bond yield has moved into the low 2% range. Longer-dated bonds have risen further, with 30-year yields approaching 4% and 40-year yields moving above that level. In isolation, such figures may not appear extraordinary by international standards. However, the article emphasizes that Japan's financial environment has been defined for decades by near-zero yields. In that context, these movements are not incremental adjustments, but represent a structural break from established norms. Japan's position within the global economy amplifies the importance of this development. The country is described in the article as a major creditor nation and a long-standing exporter of capital. Japanese financial institutions, pension funds, and insurers have accumulated significant holdings of foreign assets over many years. These include foreign government bonds, equities, and particularly United States Treasury securities. When domestic yields in Japan were minimal, these institutions sought returns abroad, reinforcing demand for global financial assets. As outlined in the article, rising yields within Japan change those incentives. Higher domestic returns reduce the necessity for Japanese capital to seek yield overseas. The article explains that this creates the potential for capital to move back into Japan, a process commonly referred to as repatriation. When capital is repatriated, it does not simply shift locations quietly. Instead, it can withdraw liquidity from global markets, affecting asset prices and funding conditions. The bond market plays a central role in this process. The article underscores that bond markets are not merely investment vehicles, but are foundational to the pricing and availability of money throughout the financial system. And when bond yields rise, borrowing costs increase and the value of existing bonds declines. In Japan's case, the article notes that the country carries a substantial debt burden. As yields rise, servicing that debt becomes more costly, placing pressure on government finances and public budgets. Historically, Japan addressed this challenge through extensive intervention by its central bank. The Bank of Japan purchased large quantities of government bonds to suppress yields and stabilize the market. According to the article, this policy was not only a monetary strategy, but also an acknowledgement of the difficulty Japan faced in allowing market forces to determine interest rates under such high debt levels. However, the article indicates that this approach has become increasingly difficult to sustain. Currency dynamics are identified as a key factor in the shift. The article explains that maintaining low yields through aggressive bond purchases contributed to a weaker yen. While a weaker currency can offer short-term economic advantages, it also raises the cost of imports, including energy and food. Over time, this increases the cost of living and places pressure on households and businesses. The article describes this as forcing a policy choice between defending the bond market or stabilizing the currency. According to the article, prioritizing currency stability requires reducing bond purchases and allowing yields to rise. This adjustment exposes the bond market to market pricing and leads to falling bond prices. As bond prices decline, balance sheets across the financial system are affected. Institutions holding large quantities of bonds may experience valuation losses, which in turn influence their broader investment decisions. The article further states that the implications extend beyond Japan's borders. Japanese institutions are among the largest holders of foreign assets, including U.S. equities and government debt. If these institutions reduce foreign exposure or sell assets to address domestic balance sheet pressures, the effects could be felt across global markets. The article stresses that such actions are driven by funding mechanics rather than sentiment or short-term news events. This evolving situation sets the stage for broader consequences across international financial markets. As Japan's bond yields rise and incentives shift, global liquidity conditions may tighten. The article positions this moment as a turning point, not defined by a single event, but by gradual changes in capital flows and funding structures. With these foundational dynamics now in motion, the detailed mechanisms behind these potential global effects warrant closer examination, which will be explored further as we move into the next part of this report. As the situation develops, the article explains that the consequences of rising Japanese bond yields extend directly into global financial markets through institutional balance sheets and funding structures. When bond yields increase, bond prices move lower. This inverse relationship means that institutions holding large quantities of Japanese government bonds experience declines in the market value of those holdings. According to the article, these bonds have traditionally been viewed as stable assets within institutional portfolios. When their value declines, it creates measurable gaps on balance sheets that must be addressed. The article outlines that when institutions face balance sheet pressure, they typically seek liquidity to stabilize their positions. The most common method is the sale of assets that are both liquid and have accumulated gains over time. In many cases, these assets are foreign holdings, including equities and government securities issued outside Japan. The article notes that this dynamic increases the likelihood that Japanese institutions may reduce exposure to international markets as domestic conditions change. This process is not driven by sentiment or economic outlook alone. The article emphasizes that it is mechanical in nature. Institutions respond to valuation changes and funding requirements by reallocating capital. As a result, sales occur based on liquidity and portfolio construction rather than market confidence. This distinction is important because it means that asset sales can take place even in the absence of negative economic news. A significant portion of this exposure involves assets denominated in foreign currencies, particularly US dollars. The article states that Japanese institutions have accumulated large positions in United States government debt and US equities over many years. These assets form part of the global financial system, the S-core holdings, and are widely owned by institutional and retail investors alike. When Japanese institutions adjust these positions, the impact is not confined to a single market segment. The article further explains that rising yields also affect a long-standing funding strategy known as the yen carry trade. For many years, the Japanese yen served as a preferred funding currency due to its low borrowing costs. Investors borrowed yen at minimal interest rates, converted the funds into other currencies, and invested in higher-yielding assets. This strategy supported a broad range of investments across global markets. As Japanese yields rise, the cost of borrowing in yen increases. The article notes that this reduces the profitability of carry trades and introduces additional risk. When funding costs rise or currency conditions change, investors using this strategy may face margin pressure. In such situations, positions are often reduced or closed not by choice but due to contractual obligations or risk management requirements. The unwinding of carry trades, as described in the article, can lead to rapid asset sales across multiple markets. These sales occur as leveraged positions are reduced and funding exposures are closed. Importantly, the article points out that this type of market movement can happen even when there is no significant new information or headline event. The selling is driven by funding mechanics rather than changes in economic data. The article describes this process as self-reinforcing. Rising yields signal tighter funding conditions. Tighter funding conditions lead to reduced risk exposure. Reduced exposure leads to asset sales, which in turn can trigger additional margin requirements. These margin requirements prompt further selling, creating a feedback loop. This loop can persist until positions are sufficiently reduced or funding conditions stabilize. According to the article, this mechanism affects multiple asset classes simultaneously. Equities, credit markets, and alternative assets can all experience pressure during periods of funding stress. The common factor is not the nature of the assets themselves, but their reliance on leverage and low-cost funding. When that funding becomes more expensive or less available, asset prices adjust accordingly. The article places particular emphasis on the role Japan has played in maintaining global liquidity over the past several decades. Japanese capital flows contributed to an environment where financial conditions remained accommodative for extended periods. As this contribution diminishes or reverses, markets must adjust to a different liquidity backdrop. The article frames this adjustment as gradual rather than sudden, marked by persistent pressure rather than isolated shocks. Another important element discussed in the article is the impact on currency markets. When Japanese institutions sell foreign assets and repatriate funds, they often convert foreign currencies back into yen. This process increases demand for the yen, while reducing demand for other currencies. According to the article, this can contribute to yen appreciation, which further affects funding dynamics tied to yen-denominated borrowing. This interaction between bond yields, currency movements, and funding conditions creates a complex set of feedback effects. The article notes that as the yen strengthens, carry trades become more expensive to maintain. This places additional pressure on leveraged positions and can accelerate the unwinding process. The result is a tightening of global financial conditions that extends beyond Japan's domestic economy. The article also highlights that these developments should not be interpreted as a commentary on Japan's economic viability. Japan remains a major industrial economy with substantial savings and institutional capacity. The focus, instead, is on the structural role Japan has played within the global financial system. Changes in that role have consequences for how capital moves and how markets are funded. As these dynamics continue to unfold, the article makes clear that the implications are not limited to short-term market fluctuations. They represent a broader adjustment in how liquidity is supplied and priced globally. Understanding these mechanisms provides essential context for assessing developments in other major markets, including those in the United States. With that framework in place, attention now turns to how these shifts intersect with U.S. financial markets and global debt issuance, which will be addressed in the next part of this report. The article explains that the developments in Japan's bond market have direct implications for the United States, particularly through the U.S. Treasury market. Japan is identified as one of the largest foreign holders of U.S. government debt. For many years, Japanese institutions have played a significant role in supporting demand for U.S. Treasury securities. This demand has helped stabilize yields and supported broader financial conditions in the United States. According to the article, any reduction in Japanese participation in the U.S. Treasury market changes the balance of supply and demand. If Japanese institutions reduce purchases or begin selling existing holdings, U.S. Treasury auctions may face weaker demand. In such circumstances, yields may need to rise to attract alternative buyers. Higher yields, in turn, increase borrowing costs across the U.S. economy. The article emphasizes that rising U.S. yields affect multiple sectors simultaneously. Higher interest rates influence mortgage costs, auto loans, corporate borrowing, and banking conditions. These effects occur regardless of whether the broader economy appears stable at the time. The article notes that bond markets respond primarily to buyer participation rather than economic sentiment. The article further outlines that if foreign demand for U.S. Treasuries weakens, domestic buyers must absorb a larger share of new issuance. This includes banks, institutional investors, and households. However, these groups face their own constraints, including regulatory requirements, balance sheet limitations, and inflation pressures. If domestic demand does not fully offset reduced foreign participation, the remaining buyer with sufficient capacity is the central bank. The article states that central bank intervention in the bond market is not a neutral action. When a central bank becomes a major purchaser of government debt, it stabilizes yields but also increases the supply of currency. This trade-off has implications for currency value and inflation expectations. The article highlights that this dynamic represents a recurring policy challenge in debt-heavy systems. The discussion then broadens to the concept of global liquidity. The article explains that for many years, financial markets operated in an environment where liquidity was readily available. During periods of stress, central banks lowered interest rates or expanded balance sheets to support markets. This pattern conditioned investors to expect rapid stabilization following market disruptions. However, the article notes that the current situation differs because the source of low-cost funding itself is changing. Japan, AES' role as a provider of inexpensive capital is being altered by rising domestic yields and shifting currency dynamics. When the source of liquidity tightens, the effectiveness of traditional policy responses becomes more limited. The article introduces the concept of a prolonged adjustment rather than a sudden crisis. Instead of a sharp market collapse, the article describes the potential for a drawn-out period characterized by weaker rallies and limited recoveries. In such an environment, asset prices may struggle to regain previous highs despite intermittent positive economic data. A key mechanism discussed in the article is structured liquidation. Large institutions managing substantial portfolios do not typically exit positions abruptly. Instead, they reduce exposure gradually, selling into market strength over extended periods. This process can weigh on asset prices without producing dramatic single-day declines. As a result, markets may appear stable on the surface while underlying selling pressure persists. The article explains that this type of market environment can be challenging for investors accustomed to rapid recoveries following declines. In prior liquidity-rich conditions, market dips were often followed by swift rebounds. In contrast, during periods of tightening liquidity, price declines may not reverse quickly, and repeated attempts to recover can stall. Currency movements add another layer to this adjustment. As described in the article, when Japanese institutions repatriate funds, they convert foreign currencies back into yen. This increases demand for the yen and can lead to currency appreciation. Yen strength further tightens conditions for positions funded in yen, reinforcing pressure on carry trades and leveraged investments. This feedback loop intensifies the global impact. So in the act of repatriation, not only withdraws capital from foreign markets, but also strengthens the funding currency, increasing the cost of remaining positions. The article describes this as a reinforcing cycle that accelerates the withdrawal of liquidity from global markets. The article clarifies that this process does not remain confined to hedge funds or specialized investment vehicles. While leveraged funds may experience the effects first, asset sales ultimately occur in public markets. When large positions are reduced, the impact spreads to widely held securities and major indices. This transmission mechanism explains how funding stress in one area can affect multiple asset classes simultaneously. The article also addresses a common misconception regarding currency behavior. It explains that even if a country faces long-term fiscal or structural challenges, its currency can strengthen in the short term during periods of deleveraging. This occurs because investors close positions and repatriate funds, increasing demand for the funding currency. In Japan's case, this dynamic can intensify the global adjustment process. The broader implication, as stated in the article, is that markets respond primarily to changes in incentives and funding conditions rather than narratives or headlines. When the cost of money rises or funding availability declines, asset prices adjust accordingly. These adjustments can occur gradually, making them less visible but no less significant. As the article concludes this phase of the discussion, it underscores that the developments in Japan are not isolated economic events. They represent a shift in the global financial architecture that has been in place for decades. With liquidity conditions changing and funding structures adjusting, the next stage involves understanding how policymakers and markets may respond to these pressures. That focus will be addressed in the final part of this report. As the article brings the discussion toward its conclusion, it emphasizes that the developments unfolding in Japan's bond market represent more than a localized financial adjustment. They reflect a broader structural shift within a global system that has long depended on low interest rates, abundant liquidity, and stable funding sources. Japan's transition away from decades of near-zero yields alters one of the foundational pillars supporting international capital flows. The article reiterates that Japan's bond market has historically been viewed as a stable anchor within the global financial architecture. Japanese government bonds were widely treated as low-risk collateral and a reliable store of value. As yields rise and bond prices fall, that assumption is being challenged. When traditionally stable assets become volatile, it signals underlying stress within the financial system rather than isolated market noise. A central point highlighted in the article is the importance of government bonds as collateral. Bonds are used extensively in lending, repurchase agreements, and leverage structures across the financial system. When the value of this collateral declines, institutions that rely on it may face tighter lending terms or margin requirements. These pressures can force asset sales, not because of changes in long-term outlooks, but because of immediate funding needs. The article explains that this dynamic links Japan's bond market directly to broader financial conditions. When Japanese institutions experience valuation losses on domestic bonds, they may seek liquidity by selling assets elsewhere. These sales often involve highly liquid securities, including major equity indices and government bonds issued by other countries. As a result, stress originating in one market can propagate across borders and asset classes. Attention is also given to the U.S. Treasury market, described in the article as the foundation of the global financial system. U.S. Treasuries serve as benchmarks for pricing, collateral for financial transactions, and a reference point for interest rates worldwide. The article notes that if foreign demand, including demand from Japan, weakens, the U.S. government may need to offer higher yields to attract buyers. This adjustment has wide-ranging implications for borrowing costs and financial stability. The article outlines the limited set of responses available in such circumstances. Governments can allow yields to rise, increasing the cost of servicing debt, or central banks can intervene by purchasing bonds to stabilize markets. Each option carries trade-offs. Higher yields place pressure on budgets and economic activity, while central bank intervention increases the supply of currency and affects its value. The article stresses that these trade-offs are not theoretical. They reflect recurring challenges faced by debt-heavy systems when interest rates rise. The process of managing these pressures often unfolds gradually through policy adjustments and market responses, rather than through a single decisive event. As a result, the effects may be felt over extended periods, rather than in sudden shocks. Another theme underscored in the article is the behavioral impact of prolonged liquidity changes. Investors conditioned to environments where market declines were quickly reversed may find adjustment difficult. In periods where liquidity tightens, price movements can become uneven, with rallies losing momentum and recoveries failing to sustain. This environment can create confusion, as positive economic headlines may coexist with weak market performance. The article also revisits the role of currency movements in reinforcing these trends. As Japanese institutions repatriate capital, demand for the yen increases. Yen appreciation, in turn, affects funding strategies that rely on borrowing in yen. This interaction tightens global financial conditions further, reinforcing the withdrawal of liquidity from international markets. Importantly, the article clarifies that these developments should not be interpreted as a judgment on Japan's economic resilience. Japan remains a major economy with substantial industrial capacity, savings, and institutional depth. The significance lies not in economic decline, but in the adjustment of long-standing financial relationships that have shaped global markets for decades. The article frames the current period as a transition rather than an endpoint. Changes in bond yields, capital flows, and funding conditions are described as signals that a previous monetary regime is evolving. This evolution affects how money is priced, how risk is managed, and how capital is allocated across the global economy. In closing, the article emphasizes that financial systems often reveal stress first in areas that attract little public attention. Movements in long-dated government bonds and funding markets may appear technical, but they carry broad implications. Japan's shift toward higher yields represents such a signal, highlighting changes in incentives that ripple through markets worldwide. As these dynamics continue to unfold, the article concludes that understanding the mechanics of funding, liquidity, and capital flows is essential for interpreting market behavior. Rather than focusing on isolated price movements, the broader context lies in how the cost of money is changing and how institutions respond. With one of the world's primary sources of low-cost capital adjusting its position, global markets are entering a period defined less by easy liquidity and more by structural recalibration.